Financial markets can look like a total mess, right? Charts going all over the place. Well, today, we're going to cut right through all that noise. We're breaking down a systematic way to trade, turning that chaos into a clear, actionable model you can actually use.
So where do you even begin? I think that's the fundamental question every single trader asks. With all this action, where are the real opportunities? The secret, as you're about to see, is knowing exactly where these pools of liquidity are hiding and, more importantly, what to do when price finally gets there.
So here's how we're going to break it down. First, we'll cover the foundations, timing and targets. Then, we'll decode the specific entry triggers you need to look for. After that, we'll put it all together into a simple three-step model. And finally, we'll walk through a real trade step by step.
Okay, first things first. Before you even think about hitting that buy or sell button, there are two things you absolutely have to know: when to trade and where you're aiming. This is the bedrock, the foundation everything else we're going to talk about is built on.
This entire strategy revolves around very specific windows of time, what traders call kill zones. Seriously, think of these as the market's rush hour. It's when the big players in London and New York are most active, which means volatility and liquidity are just peaking. We are not trading all day long. We are precision hunters, and we only operate during these key hours.
So, okay, why do we care so much about these specific times? Well, it's because that's when we expect the market to make a run on liquidity. Now, liquidity, just think of it as big pools of money, basically stop-loss orders, that are just sitting there above old highs and below old lows. These spots act like magnets for price because big institutions know that's where they can get their huge orders filled. Our job is to see these stop rates coming. And check this out. This is where the rubber meets the road. Look closely at this chart. See how the price kind of goes sideways for a bit, and then, bam, it makes this super aggressive move down. And notice when it happens? Right inside that New York session window, heading straight for that sell-side liquidity level. It's a perfect case of timing and target lining up.
Okay, so we know when to look and we have a good idea of where price is probably going. But how do we actually get in? What are the specific, repeatable patterns that scream high probability setup? Let's open up the toolkit and look at our entry triggers.
All right, so our whole toolkit for getting into a trade really just boils down to three core patterns. Now, they might look a little complicated at first glance, but these are basically our green lights. They tell us a trade might be ready after that liquidity raid we talked about. We're going to look at each one: the MSS plus FVG, the CISD, and the IFEG. Let's start with that first one.
First up, we've got the MSS plus FEG. Now, what does that even mean? Well, the market structure shift, or MSS, is your first clue. It's when price breaks a recent little swing high or low, hinting that the trend might be changing. Then, that move is confirmed by a fair value gap, which is just an imbalance left behind by a really fast, aggressive move. The two together are like a 1-2 punch that signals a big potential reversal.
All right, next up is the CISD, which stands for Change in the State of Delivery. I know, it sounds super technical, but trust me, it's actually really simple to spot. All it is a sudden, super aggressive reversal. Price was going one way, and then it just violently shifts direction. That powerful move leaves behind what we call an order block, and that little area becomes our new launch pad, our precise entry point.
And our third and final pattern is the inverted fair value gap, or IFVG. This one's cool. It happens when price just blasts right through one of those old fair value gaps we talked about earlier. When that happens, the gap basically inverts its role. Well, once a gap now becomes a new floor or ceiling, support or resistance, giving us a very specific spot to watch for a reaction.
Okay, so we've got our timing, we've got our entry patterns. These are the pieces of the puzzle. Now it's time to put it all together into a simple, repeatable blueprint. A three-step process you can use on any trade.
The whole thing, and I mean the entire model, just boils down to these three logical steps. We start with the big picture, the high time frame. Then we zoom into the medium time frame to find our trigger. And finally, we get super precise on the low time frame for our entry. It's a classic top-down approach.
All right, step one. We always start with the big picture. We're looking at a daily or a 4-hour chart, and we're just trying to find a major level where we expect a big reaction. In this example right here, we found a key order block. That zone, that becomes our hunting ground.
So, prices hit our zone. Now what? We don't just jump in. This is step 2, and it's all about patience. We zoom into a medium time frame, like a 15-minute chart, and we just wait. We're patiently watching for one of our 3 entry patterns to show up and confirm our idea. And right here, you can see it.
a beautiful CSID pattern forming right at our high time frame level.
And this brings us to the final and maybe the most crucial step, refinement, step 3. We drill down one last time, maybe to a 5-minute chart, to pinpoint our exact entry inside that bigger zone we found in step 2. Why do we do this? Simple. It lets us get in with a super tight stop loss, which just completely juices our potential risk to reward ratio.
All right, enough theory. We've got the tools, we've got the 3-step model, that's all great on paper. But let's see how this thing actually performs in the wild. Let's watch it all come together in a complete trade from start to finish. So here's our trade. We're starting on the daily chart. That's step 1, remember, the big picture. We can clearly see price pulling back into a large fair value gap, and our main target is that big pool of sell-side liquidity sitting just underneath it. We now have our plan.
And boom, look at this. This is a perfect illustration of our trigger. Step 2, price dips down, grabs that first pool of liquidity, and then immediately reverses with incredible force. See that massive green candle, that aggressive move up? That's our CISD pattern. That's the confirmation that buyers are stepping in with serious conviction. So, we got our confirmation. Now, we execute step 3. We jump down to the 5-minute chart to refine our entry based on that CISD pattern. And you can see from the tool on the chart, this gives us a razor-sharp entry, a very clear stop loss right below the low, and a huge potential target way up high. And here's the payoff. The trade plays out exactly as planned. Price just rockets up all the way to its ultimate target, taking out that liquidity we spotted way back in step 1. This just perfectly shows how the model connects all the dots across different time frames into one single cohesive trade. So, what's the big idea here? It's that having a system, a real framework, changes everything. It takes what looks like random noise and turns it into a series of clear, logical steps. When you combine the right timing with proven patterns and a simple process, you create something really powerful.
So you see, this isn't just a bunch of random tips, it's a full-on blueprint. It gives you a clear path from that high-level, big-picture view all the way down to a precise entry, giving you a totally new way to look at the markets. So now you've got the framework. The real question is, what are you going to go analyze first?